I think the forming and breaking of the great bubbles are really the only thing that really matters in equity management. The rest of the time, show up, keep your nose clean, make a point or two, lose a point or two. It doesn't really matter. But once in a blue moon, typically every 20 years, but more recently, a little more frequently than that, you have these bubbles. They form over a number of years, they dominate everything, and then they break, and once again, they dominate everything. It really does matter. And if you can bring yourself to sidestep some of the pain, it can make a lot of difference. I don't think the bubbles are hard to spot, but that is my specialty. I look at the handful of real McCoy bubbles, the type that have really crazy investor behavior, that have masses of enthusiasm, and they stand out like a sore thumb. 1929, the 2000 tech bubble, the 2007 housing bubble in the US, Japan in 1989, both land and housing and the stock market, probably the biggest bubbles of both the equity market and the real estate market in the history of man. So they are the real McCoy. And then there's an interesting almost case of 1972, the Nifty 50. It didn't go quite as high, and it wasn't quite as silly, but it was on the cusp of oil crises and so on, so that it went down a whole lot. It went down every bit as much as some of the others. A 62% decline adjusted for inflation in 1973-74, still the biggest decline since the 1930s. So that's my universe. And here we are. We have checked off all of the indicators that are unique to those handful of events. Crazy behavior, check, check. The Bitcoins of the world and the cryptocurrencies, the meme stocks of the AMC, GameStop variety. I could even add my QuantumScape, and very rapid acceleration the prior year in 2020, where the NASDAQ more than doubled in the year. And even from the beginning, pre-COVID, was up almost 60%. Up almost 60% despite a huge wipeout from COVID. So rapid acceleration is a characteristic you have to see. Crazy behavior you have to see. And then there is a unique and special case, and that is on the upside, and that's important. On the upside, the blue chips start to win. And the stocks with the very high volatility that normally go up 1.5 or 2 times the blue chips, they don't even get the sign right, and they start to go down. 1929, the specs, the really crazy stocks went down all year. Little known fact, but they did. The day before the crash, they were down 30% as an index. Nothing like that happened again until 1972. 1972, in the Nifty 50, the S&P went up 17, and the average big board stock went down 17, so that I could remember it forever. Symmetry. Nothing like that happened again until 2000. And then in 2000, in the tech bubble, the dot-coms peeled off in March and really collapsed. And then through the summer, the junior growth, the medium growth, and then finally the senior growth all peeled off. And by the early fall, most of them were down 50%. And some of the dot-coms were down a lot more. But the S&P was unchanged, which meant that the 70% that was not growth had gone up 18%. So the S&P blue chips had gone up 18, and the growth and the NASDAQ and the dot-coms had taken a very big hit. That is absolutely classic. Now, starting early last year, one by one, the various most speculative groups that had done brilliantly in 2020 started to do badly. These great bubbles have nothing to do, very, very little to do with the underlying reality. That started in 2020, December. And then the meme stock started March, April, and Bitcoin, April, May, June, and so on. And then one by one, most of the advanced techie stocks started to come down. And ARK peaked out a couple of months later and has, of course, declined 75%. ARK is a whole portfolio of 25 growth stocks that often have no earnings, but do have, at least in the portfolio manager's belief, huge prospects. But that kind of stock is very vulnerable to a loss of confidence. And therefore, it started the decline pretty early and continues today right into the teeth of the sell-off. So this market has been proceeding eerily like 2000. And I think phase one, superficially, you have a 2000 tech bubble. Horribly overpriced, much too much enthusiasm, huge buy-in by individuals, fueled by a massive program of cash distribution associated with COVID bailout. A lot of that found its way into the stock market. So this was.
Thanks for watching. Don't forget to like and subscribe.